Right, I think we're away. Good afternoon, everybody. There are a number of people yet to join us. I think the numbers are not quite. I had a warning that I was unmuted, and yet the little green line was bouncing up and down in the microphone icon. Right, so good afternoon and welcome to the second of our summer auditing webinar series. Let's avoid that light behind my head. Of course, most of the time you'll be looking at slides, not of me, which is you're probably quite relieved about that. Before we get into this afternoon's topic, I was considering the polls that we did in the materiality session last month, and I confess, quite surprised at the breadth of the selections from the options. So I think the lesson from that is that it's extremely important to record on our audit file not only which basis we have chosen for our materiality and which percentage, but why. It is because it is a matter of professional judgment. Just because Bill Heritage would choose a different percentage or a different basis doesn't mean that the one you've chosen is wrong. Definitely not. But we should put the reason that we've chosen that particular basis and then that particular measure. So, right, preconditions for an audit. Get back to the slides. And what are we going to talk about? Well, a precondition, of course, pre meaning before. A precondition is a condition that has to be satisfied before an audit can commence. Hang on, I'm going to get back to me. Start with a little story. Why did I choose this topic? Well, it all goes back some years when I did a review on behalf of the Financial Markets Authority of a licensed auditor, and the file that I selected was declared as an issuer audit. Remember issuers? That's not all that long ago. And the client denied that they were an issuer. The director said, no, we're not an issuer. And they used, and this dates it, the old New Zealand generally accepted accounting practice to prepare the accounts. And the auditor said, no, I think you're an issuer. You should be using NZ-IFRS, and qualified the audit report accordingly, which seemed to me to be a particularly reasonable thing to do. In the particular circumstances of that company, the difference in the numbers between old New Zealand GAAP and NZ-IFRS was, well, probably nothing. Certainly nothing material, but certainly the disclosures under NZ-IFRS would have been quite a bit more. So the auditor qualified, and I drafted a report. And when the report came back, it had been edited by the manager of the reviewing team to say that because the reporting framework hadn't been agreed, so the director said said old NZ GAAP, the auditor said no, it should be NZ-IFRS. That was a precondition to the audit, and the auditor should not have accepted the job at all, which I thought then, and I still think now, is actually a pretty silly notion, but that is indeed the rule, and this is why we're going to look at preconditions for an audit today. And now, one of the troubles with the last webinar was that my webinar controls vanished behind the slides. I think I fixed that by tweaking some settings. Anyway, what are we going to do? Well, we're going to look at the definition of preconditions. I've already told you what they are, but what the standards say they are. What the auditor must do, because it's very explicit, the auditor must do certain things. Then the particular case of a major limitation of scope, we'll look at that. And then what to do if the preconditions are not present. And it's not always simply decline the audit, although that's certainly the most common. And then when preconditions for an audit and the law collide, and this is an interesting one, although I don't think it's likely to affect too many audits in New Zealand. Okay, here is the definition. It's in ISO NZ 210, which is the one that describes agreeing the terms of an audit and all the preconditions. They're also mentioned in ISO 200, but ISO 200 is basically saying the same thing, so we're not going to look at that. And the preconditions are the use by management of an acceptable financial reporting framework, and the agreement of management and, where appropriate, those charged with governance to the premise on which an audit is conducted. Now, in New Zealand, particularly in the smaller audits, but pretty much every audit I can think of, the terms of the audit are agreed with those charged with governance, not with separate management. However, that's what the standard says, and so I have to tell you what the standard actually says. De facto, we have to get the agreement of the directors, the trustees, whoever are those charged with governance, to the premise on which an audit is conducted, which can be boiled down to the reporting framework has to be acceptable, which is the situation that I described in the story. And the client has to agree to stuff. Yes, that's what it says. The client has to agree to certain things. Let's have a look at those things. What is the stuff? Okay, it's the client, it's the acknowledgement of responsibility for preparation of financial statements in accordance with the framework. So we, the directors, are responsible for, possibly on behalf of the company, are responsible for preparing financial statements in accordance with whatever the framework is. They are responsible for fair presentation. Now, this is absolutely good phraseology if we're talking about a GAAP framework, generally accepted accounting practice. If it's special purpose, then special purpose isn't designed to give a fair presentation, not necessarily. And so we may have to modify that, although the standard, oddly enough, doesn't say so. Doesn't take into account the possibility of a special purpose framework, but we might have to express it in terms of comply with the framework. And they are responsible for sufficient internal control. Now, nearly everyone's engagement letter has paragraphs that cover this because where they've been copied from someone else's engagement letter or from the text in the standard. Fine, and now you know why they're there. And this one doesn't appear in everybody's engagement letter, but it should. It's provision of access to all information and all personnel. Now, I can't remember an audit where that's been withheld or overtly withheld. I can remember an audit where there was a temporary attempt to divert the auditor from talking to certain people, but that was quickly knocked on the head. So one of the preconditions is that the auditor must be given access to all information in the organisation and all people in the organisation. And so whether it's in the Act or not doesn't matter, because if the client won't give us that access, we don't do an audit. So the limitation of scope. Now, and I actually haven't ever come across this, but and it's hard for me to even think of an example. But if there's a limitation on the auditor's work, perhaps the auditor is not allowed to directly communicate with the chartered accountants who are preparing the statutory financial accounts. Now, that would be a limitation of scope, and that would be pretty unacceptable. And you might decide it's so important that the final audit report will likely be a disclaimer of opinion. So there'll be no opinion at all. And if we come across these such a very rare occurrence, the answer is we must not accept the engagement. We must not do the audit. So if there's a more modest limitation, which might result in a modification but not a disclaimer, we can still go ahead. But if the limitation is such a big one that we're going to say, hey, we can't form an opinion, then we don't even accept the audit. Unless, of course, we're required to by law. Now, the standards mention requirements to do an audit by law. And in New Zealand, I can only think that this applies to the Auditor General, who is required by law to do quite a few audits. And I can't imagine anyone standing up to the Auditor General for very long and trying to limit their scope. But anyway, if someone did, the Auditor General would still be obliged to carry on and do the audit and issue an appropriate disclaimer. But for the rest of us, that's very, very unlikely to be the case, that we are required by law to do an audit. Okay, those are the preconditions. Hang on, look, it's not 1/4 yet. Aha, but there is more to come. What happens if the preconditions are not present? And the answer is not the first thing is to walk away. It's one, to discuss with management. So we go back to the client and we say, there's a precondition for an audit that's not present. You have declined to sign an engagement letter that gives us access to everybody, or to take responsibility for internal controls for whatever reason. And we discuss it with management and explain that if they continue with that stance, we can't do the audit, nor can any other ethical auditor in New Zealand. So it's a must-have. And I would imagine that in virtually every case, then management will back down, the client will back down and say, okay, go ahead, because they are only looking for an audit because they can't avoid it. So you discuss with management, and then we get this unless required by law bit. But if management don't agree, and we're not required to do the audit by law because we're not the Auditor General, then we decline the audit. So it's not exactly, if preconditions are not present, decline. There are two steps in between. One is discuss it with management and explain to them, and then check that whether or not we're required to do the audit by law. I don't think anyone who's registered for these webinars is likely to be required by law to accept a particular audit, but it might happen. So, the special case. Of course, it's a special case. Now, this is the special case is when the financial reporting framework is unacceptable. So the client says, we're going to use such and such a reporting framework, and we say, as auditor, that's unacceptable to us. And they say, but the law says we have to do it that way. Now, I personally think that NZ-IFRS is for nearly all circumstances a totally inappropriate financial reporting framework, but I don't think that personal view will translate into my official view as an auditor. Just because I don't like NZ-IFRS for a whole string of reasons, and it is definitely required by law for certain for-profit entities, then I think that I would not be looking at this particular provision of the standards. I would have to be looking at it in terms of, well, I don't like it, but the powers that be tell me it's the right, acceptable, and indeed only reporting framework. But there may be strange circumstances when the framework required by law is unacceptable to the auditor. And that says, well, we can't just walk away from it because they'll never get an audit. So we can accept the audit, but there's conditions. One, the client agrees to provide whatever additional disclosures are required to make the end product more or less acceptable. Then the engagement letter states that the audit report will include an emphasis of matter paragraph. Ooh. And then, of course, the audit report will include an emphasis of matter paragraph, drawing the reader's attention to these additional disclosures. And the engagement letter will also state that the expression present fairly or something similar like true and fair view will not be used, which would be, that would be an exciting one if I was the auditor and I officially took the view that NZ-IFRS was unacceptable. And said, dear directors, you may not use the expression present fairly. So I've never come across a case where a legally required framework is something that I would officially find unacceptable. So I've never come across such circumstances in this special case. But we better know that it's there because it can be, particularly I think in the not-for-profit area, there might be some cases where you might say that the PBE Tier 3 or Tier 4 standard is unacceptable because it doesn't provide for certain disclosures that you think is really, really important. So, but there is the special case there. You need to know about it. And because I can see my controls, I see that there's a question. We didn't re-rehearse the, but I can't read the question unless I stop the slides. Excuse me. Okay. Okay, we had a situation following the 2011 Christchurch earthquakes where the client files were inaccessible, destroyed. We didn't have enough evidence to provide an unmodified audit opinion. What should we do in a situation such as this? Okay, well, let's go back to the, what a very good question. Okay. Now, that's a case that's not being contemplated by the standard. See, this is the situation, and the auditor's work is limited, but it's not limited by the conscious action of the client. It's limited by circumstances, act of God, if you like. And I would say that what you have to do is depart from the auditing standard and document why you've departed, because this is absolutely not what the authors of the standard contemplated, that there was a complete, and in fact, in the audit reporting standards, there are examples of audit reports if certain accounting records have been lost. You know, the people in London and New York who write these international standards have probably never lived through an earthquake and don't understand that there are circumstances when all accounting records may be lost because they're in a red stickered building. That's a very good question, but on the strict interpretation of the standard, you would have to say, no, I can't do that audit. But as I say, this is one of those circumstances where I would recommend that the auditor depart from the standard and document why. That's done. Okay, right. Now we will. Getting a strange message. I've not had that one before. Let's go back to the slides. No, computers, you can't trust them, you know. Okay. Oops. Okay, we'll try stopping that entirely and going back to hopefully you now see a slide that says accepting the framework. If you don't, someone send me a message in the chat, please. Right. Okay, accepting the accounting framework. It is really essential to understand the statutory requirements because they are quite complex these days. There are lots of ifs and buts. And I think most auditors have a pretty good understanding of them. You will doubtless remember that in 2014 there was a major shake-up. We had the Financial Markets Conduct Act brought in, we had the Financial Reporting Act rewritten, and at that time Thomson Reuters asked me to write a special newsletter, they call it a bulletin, on all the changes. And I thought that it's still the only place I know where all the reporting requirements are gathered in one place, and I quite frequently refer to my copy. So I asked Thomson Reuters, who owned the copyright, would they be willing to have me share this material with you? And they didn't only say yes, they invited me to update it. Now that all happened quite late yesterday afternoon, so it will be after this session you will receive an email with attached a PDF of an updated bulletin describing all the statutory requirements for common entities. Isn't that nice? A free extra. You didn't know you were getting that. And there's, Well, if you want to pay for it, that's fine. I'll accept any donations, but you're not expected to. So, because it is important to understand who has to report using which framework. Large. We know what large is, don't we? So we'll do some, we'll give you some scenarios, which I think means I have to, oops. Here we go, identifying a large company. Now, I'm sure you can remember from last month how to vote. And I think I found out why we got some polls last time that added up to more than 100%. But anyway, this one is at 31st of March 2017. ABC Limited had assets of 65 million, previous year 55 million, and reported revenue of 28 million, the previous year 32 million. Question, is ABC Limited large for the year ending 31st March 2018? Okay, we'll see what. Well, we have a lot of people still thinking about it. We do have a few votes, and it's most interesting. It's, this is obviously a good brain teaser, because we're getting a fair bit of support for yes and a fair bit of support for no. How many people have? Around about half of people have voted. Now, come on, you should make a decision. You're auditors, and this is important stuff. This is technical stuff. I know it's dry, it's boring, but we have to know this because it's a precondition. If we get it wrong, we might accept an audit that we shouldn't have. Okay, 25. 80% have voted. We'll 3 more seconds. Come on, commit yourselves. Yes or no? 2, 1. End of poll. Right, now we'll see. And it's another one where the results have added up to more than 100%, and which I suspect is because there are some firms that have registered the whole team, and the team are logging in from more than one device. So people are logging in from their personal workstations or even from home. So 14 people says it's large, and 12 people voted no, it's not. And the answer, and it is an actual definite answer, it's not an opinion, is no, it's not large. To be large, it has to have assets of more than 60 million for 2 years. We've got 60 million at 65 and 55, so we've only got 1 year of assets over the limit. And we need revenue of more than 30 million for the last 2 years, and we have only 28 million in 2016. So we've not met either of the conditions. We've met one condition in both years, but the way the Act is written, and I invite you to go and reread the Act and see if you agree, I think it's quite clear that in this case, ABC is not large. So, but we'll have another. And now we'll look at DEF. And DEF Limited had assets of 29 million, then previous year 25 million, sales of 25 million, previous year 23 million. On the 1st of December this year, GHI Limited, an Australian company, purchased 75% of the shares. But previously, DEF was wholly owned by New Zealand residents. So, is DEF Limited large for the year ending 31st of March 2018? Now, there's something about that. Yeah, there's definitely something about that. And I won't give you a hint, but why would you be told that GHI is an Australian company? And yeah, there's again a lot of thinking going on. And okay, some votes are coming in. And it's not totally one-sided. Come on, we'll have some more votes. I know it's a bit difficult if you're in a little group around a screen because you want to debate it between yourselves because you only get one vote. We're going to have to think about this. Or we can get more decisions than this. It's all right. No one will know what you voted. And the important thing is that you think about this, and hopefully you're thinking about the things that do matter. Is DEF large for the current financial year? Come on. 2 more votes. We need a couple more. Just come on, a couple of votes. Come on, grab that mouse. Click. Dare to have an opinion. One more. Those who haven't voted, you know who you are. Okay, right. That was. Yeah, we'll end that one. And we do have a clear preference here. Most people think yes, and I agree with most people, because DEF Limited now is a subsidiary of an overseas company, and subsidiaries of overseas companies are the lower figures for large. So instead of 60 million assets, it's only 20 million, and instead of 30 million turnover or sales, it's only 10 million. And DEF Limited is a subsidiary as from this month. And we look at the last 2 years and we say, well, that's how it's defined. It doesn't, there's nothing there about when it becomes a subsidiary. I've looked hard. I see there's a chat saying the XRB standard talks about the 2 preceding periods. Yes, you've been given the information for the preceding periods, March 17 and March 16, and the question is it large for the current period? I think I've got, I certainly tried to take that into account. So I agree with the majority there. I think the DEF is now large, and if it's a subsidiary of an overseas company, we look at the definition of large, and definition of large talks about 2 preceding accounting periods, but it doesn't talk about it being a subsidiary for all that time. Okay. We've got one more on large. This is a good one. And here we are, JKL Limited. It's not John Kirwan Limited. Has owned land costing $100 million for many years. It has never derived any income or incurred any expenses. A strange company, but nonetheless, such things are possible. And is JKL Limited a large company for the year ending March 18? And this is probably, for those who've already voted, they know what the condition is, and they're right in there. Everybody else is thinking about it, which tends to suggest to me that they don't know what we're testing. Okay, the votes are coming in. The votes are coming in. Have some more. I'm interested. I'm intrigued by this one. Okay. But it was telling. The first two votes were in almost instantly, and I thought, aha, there's at least two people out there who know what this is all about. And okay, we'll call it quits there and share the result with you. And it's a dead heat, which adds up to 108%. And half of you have said yes, half of you said no. The answer is a definite no, because JKL is an inactive company. And so it has an exception, and it cannot be a large company. It could be $100 billion worth of assets, but if it's got no income, well, no, I think you're allowed a very, very tiny amount of income and expenses like annual return fees and so on. But basically, if it's an inactive company that's not deriving any income, not incurring any expenses, or someone else, then it can't be large. It doesn't have to do NZ-IFRS accounts. There. And a lot of us have learned something, haven't we? Right. So, end the polls and go back to accepting the framework. So we have we've had a good look at large, and then counting shareholders. The rules. There are rules about financial reporting that are dependent on the number of shareholders. Aha. Well, let's have a look at here we are. I hope that I've got things sitting on top of my little spreadsheet. Anyway, you should be able now to see a spreadsheet about NNO Limited, which has a March balance date. Let's keep things simple. And 31 March 2017, it had 9 shareholders. And there you have a little timetable. 1st of April, we issued some more new shares to 2 new shareholders, and we ended up with 11 shareholders. And then at the end of June, shareholder P transferred half of his shares to a trust. So then we had 2 shareholders. One was P and one was the P's trust, of course, which is in the share register under the trustees' names. You may not record a trust in the share register. Then in July, shareholder Q bought out shareholders R and S. Then we had our annual meeting. Good, company actually had an annual meeting. Whoa. After the annual meeting, shareholder Q bought out shareholder T. Then we get 6 months after the start of the accounting period, which I hope you recognize the significance of that date. In November, shareholder Q bought out shareholders U, V, and W. Do we see a shareholder Q clearly thinks this is a fabulous investment. And today, this afternoon, you are asked to audit MNO Limited, and I have a question for you. While you're thinking about that, I will look at the no, I think I have to stop. Think about that. We'll go back to this, but I will. And the question goes back to the previous poll about the inactive company, where there are some transactions which would not be material. I don't have the Act open on my computer, but it's definitely not about materiality in an audit sense. It wouldn't have to have much in the way of transactions to become an active company, and it would, of course, once active, it would be a large company and have to be audited, have to be using NZ-IFRS. So, okay. Right, a last look at this. Here's the timetable. Have you decided how many shareholders you think are there in terms of counting shareholders and the rules about shareholders? Where's my that's gone. Right, how many for the current financial year 2017-18, how many shareholders does MNO have for opting purposes? Because if it has a certain number of shareholders, it defaults to preparing GAAP, i.e. NZ IFRS accounts, but the shareholders may opt out. So, well, I thought everyone would have their numbers already and they'd be quick on this. Most interesting. So, no opt-out resolution has yet been passed. This is a two-part question. And so, without such a resolution, is MNO Limited obliged to prepare GAAP accounts? And this is most interesting. And oh, look, I think I'm going to claim a moral win here because there are votes all over the place. Yeah. Okay. And we've and for those that are still considering, I will remind you that at last balance date there were 9 shareholders. On the 1st of April it went up to 11. On the 30th of June up to 12. 31st of July down to 10. At the annual meeting there were 10 shareholders. At the end of August it went down to 9. Then at the end of September we ended up with 6 months after the start of the accounting period. At the end of November it went down to 6 shareholders, and now we're being asked to consider doing this audit. And I'm going to end the poll there because I think that we are probably a bit baffled based on that. Okay, right. And here are the results. Now, the most popular number of shareholders was 9. It was 9 at the end of the last period, and it was 9 at 6 months after the start of the accounting period, but that's not the right answer. And the right answer is 11, because when we're counting shareholders, and this is in the Act, it might be arbitrary, but it's in the Act, it's the number of shareholders at the close of business of the first day of the accounting period. So it's at the close of business on the 1st of April, and the number of shareholders that MNO has for opting purposes is 11. It's not an optional thing, it's absolutely, and you might say, well, that's crazy. Shareholder Q might have bought all the shares since then. Well, that shareholder Q can easily pass a resolution to opt out, but the answer is 11. Congratulations to the 2 people who went for 11. And so the answer is there were 11. No opt-out resolution has been passed. Yes, MNO Limited is now obliged to prepare GAAP accounts. If they're going to opt out, the resolution has to be passed by the earlier of the date of the annual meeting or 6 months after the start of the accounting period. So if we hadn't had an annual meeting, it would be at 30th September, but in this case, we have had an annual meeting, so any resolution would have to be passed no later than the 15th of August. Okay, and we have another question. And we've got another question going back to large. Can we park that one for a little while? It will be answered in a while. Now, and then another question on how many shareholders. This is a really simple one, so you're going to have only 20 seconds to decide. So when do we have to opt? 10 seconds. Is it 10 or more shareholders, or is it more than 10 shareholders? 5 seconds. 3, 2, 1. Okay, right. Quick. That's it. And most people got this one right. It's 10 or more shareholders. And again, this is a detail, a technical detail, but auditors have to know this because one day it will be critical. A company will come along to you with exactly 10 shareholders, and you have to know, do I ask them, have they passed or do I ask to see their opt-out resolution? And the feedback I have, which is not very extensive, is that opt-out resolutions are not often being done. I hope compilation accountants are getting the message now. So yeah, most people got that one. Let's go back to that one. Okay. And charities. Now, we all know about charities. They're tier 3, tier 4, and then they have their audit or review requirements, and most auditors are actually pretty good on this. So let's have a look at some of these. And you now should see PQR Inc., which is a charity. And the balance date is 30th of June, but who cares? Annual expenditure is 1.5 million, reporting framework PBE tier 3. Yeah, that's the one. No statement of service performance has been prepared. Now, you wouldn't have a client that would not be enthusiastic about preparing a statement of service performance. Well, think about that, because you're going to be asked to vote on whether or not you're going to accept this audit. Decide. It's a simple yes or no. There we are. Annual expenditure is less than 2 million. We're not into tier 2. It's PBE tier 3, no statement of service performance. Question: would you accept this audit? Yes or no? So it's a charity governed by the Charities Act. It is tier 3, no statement of service performance. Okay, yeah, we have supporters of both notions. There is a clearly preferred one. And okay, I'm going to 3 seconds, 2, 1. That's the end of it. And most people said no, they wouldn't accept it. Now, I agree with those. The reporting framework is the correct one, but the statement of service performance is a main statement. In fact, you could argue it's the most important part of, excuse me, most important part of the performance report for a not-for-profit, and they're not producing one. It's a bit like preparing financial statements with no balance sheet. Is this an acceptable framework? And to my mind, it isn't. I don't think it's, except that they haven't prepared a statement of service performance, they comply with PBE Tier 3. I think that that's such a departure that is in fact a different framework. But that is my interpretation, because the standard doesn't say anything about adopting a standard with humongous departure. So now we will go and look at another scenario. And this is slightly different. The bits in blue are what's changed. And what's changed here is that the statement of service performance hasn't not been prepared yet. And the committee has got the AGM coming up, and they want to present audited financials to the AGM without a statement of service performance. A full performance report will be audited and delivered to charity services later on. So this is a bit different. It's a question of statement of service performance is in the pipeline, but we want to present some audited accounts to the AGM. And it's incorporated society and a charity. And the Charities Act doesn't say that I can recall, say anything about what you present at the AGM. So the question is, of course, the same. Are you going to accept this audit? All the facts well glued into your mind. We will go to and here we go. Would you accept this audit? There will ultimately be a full set of financial statements delivered to charity services, but the AGM will get a part set of accounts without the statement of service performance. Would you accept an audit in these circumstances? Okay, yes, we have a more evenly divided view on this one. This is not an exact crib from a situation I know of, but it's based largely on one that I'm aware of, a rather smaller entity, which, okay, I think that's enough. We'll end it there, where it's a dead heat. Half of us would accept it, half of us wouldn't. I think you're permitted to accept this. This is, again, Bill's opinion. It's not something that I can find black and white anywhere. Because my view is that the law is being complied with. A full performance report will be prepared, will be audited, and will be delivered to charity services. An incorporated society has to have an annual general meeting, has to have the Section 23, I think, financial statements presented, which is really, really basic stuff. Basically, there has to be some sort of an income statement and a sort of a balance sheet-ish thing, statement of resources and liabilities. So I think it's possible to, in these circumstances. I'm not saying those that would decline it are wrong. It's, I think it's quite a moot point. But I brought it up to highlight the fact that you could have this rather strange situation and stay, as I understand it, within the law. Certainly, I would write a strong management letter to say they should get the damn thing completed before the AGM. But you know, a lot of charities, the members of the incorporated society are the members of the committee, and there aren't any others. So the accounts that go to the annual general meeting are a bit of a nonsense anyway. So we will have yet another look at a scenario. We have, and it's PQR again, still tier 3, and we are engaged to audit financial statements presented to the AGM without a statement of service performance, and that's the end of our contract. It doesn't mention anything else. So what? Yeah, study that, make up your minds. So what we don't know what they're going to file with Charity Services. We're not going to be asked to audit it. And here we are. Would you accept this audit? Now, I've already said that I think it's legal to present audited accounts to the members without a statement of service performance. I don't say I think it's desirable. I don't. I definitely don't. But can we accept such an engagement and not know what's going on outside? And okay, we've had yeah, lots of votes. There's a clearly preferred option. See, a couple of seconds for some last minute ones. Come on, click, click. That's it. And okay, the majority would say no. I would probably side with them. I don't think I'd accept this because this is expenditures over $1 million. They are required by the Charities Act to have a full set of tier 3 accounts audited. Why would they get us to audit part of that and present it to the AGM if they were going to have a full report prepared somewhere else and presumably audited by someone else? No, that's stretching credulity. So I think that they are trying to get around, trying to minimise their audit fees, or they're just stupid and they're not going to get any other report done, and I think I would decline. I think that the precondition is not met there. And the last one. Ooh. And this is PQR is now a little charity. Annual expenditure is only $75,000. Still using tier 3, though it doesn't have to. And here, no statement of service performance has been prepared yet. The committee wishes to present audited financials to the AGM without a statement of service performance. But whatever is delivered to charity services will be unaudited. Well, yeah, annual expenditure less than $500,000. They don't have to present something that's audited. Different. Okay, think about that. Fill your mind with it, and we will. Would we accept this audit? And this is just an invention. I don't know of any situation like this. Okay, we have, so very small charity, expenditure $75,000. No statement of service performance has been prepared yet. Yeah, we've got a constitution that says we've got to present financial statements to the AGM. It doesn't say we've got to present a statement of service performance. It's not, dear auditor, it's nothing to do with you what we deliver to charity services, because that doesn't have to be audited. So, would you accept that audit? We're at the end of time. So, yeah, I'm going to end the poll right there. And there we go. Not quite a dead heat. A small first past the post win to no. 14 votes to 12. I actually think that would be okay, because there are little charities out there, incorporated societies, that have a constitution that says they have to present audited accounts. Of course, if the constitution says they have to be GAAP audited accounts, generally accepted accounting practice, that includes a statement of service performance. But we didn't say that. We don't have that information. So it depends a bit on what you've assumed is in the constitution. And we've got okay. Question: what if you accept the engagement and request the client to do the statement? No, it has to be the other way around. You have to ask them to do it and get their reply first. You can't. We're talking about preconditions for an audit. This is what has to happen before we accept the audit. And someone has said, so you would have 2 audit reports for the same engagement. As how could your audit report mention the statement of service performance if it isn't there? Yes, you're quite right. You could have a situation where you would have one assignment and 2 different audit reports. I don't think that's a particularly great thing to have, because you've also got to make damn sure that they don't get mixed up, so they put the wrong audit report with the wrong set of financial statements. So now we will yes, the question about an entity is large and it goes and revenue and assets go down, is it still large? And the answer on that is that the definition is the assets and or the sales in the previous 2 financial periods. So if we have 2 periods when we're large, then so in the say in the 2016 year and the 2017 year, the numbers, we tick the boxes, tick, tick, large. Then in the 2018 year, the company is large, as defined, even if it stopped trading, which is kind of crazy, but that's the way it's written. Now, get back to the slides. And we've got to hurry. If there's no statutory framework, well, those charged with governance may choose a framework, i.e. a set of policies, and audit has to decide whether the chosen policies are acceptable. Sorry if you have to go. This is still being recorded. It will be available for future reference. And I thought we were going to struggle to fill an hour. See what happens when you're enjoying yourself, talking about auditing. So here's an example, the Tapawera Bridge Club. I don't think there are enough people living in Tapawera to form a bridge club. Anyway, it's an incorporated society, it's not a charity. And for their financial statements, would you accept PBE Tier 3? And raising the hand, and I can't see, no, it was too late, and I had to fiddle around dipping in and out of the slides. So PBE Tier 3 or Tier 4, that would almost certainly be acceptable because they're for not-for-profits, and they are frameworks that are good enough for charities, and the Bridge Club is not a charity, so I think they would be fine. SPFR probably would be fine as well, but remember the F part is for-profit, special purpose for-profit reporting framework. I can't think of it immediately of anything in SPFR that would be inappropriate for the Bridge Club, except it might be a bit too extensive. And then we have the treasurer of the Tapawera Bridge Club says, hey, I can do special purpose. I don't have to do any framework. So he's going to choose his own policies, and one of those policies is to show a loan at face value. It's a loan, a large loan to another bridge club, but the borrower bridge club happens to be insolvent. Oh, that's okay. They will pay it back one day. I'm going to show it at face value. And is this acceptable to you as auditor? We're not going to do a poll because we're out of time. My strong view is that that is not acceptable. That's not an acceptable way to report to members. It wasn't taken from real life, although it wasn't a bridge club, it was a different kind of club, and it was in Auckland. And they truly did show a loan that was roughly half their own equity to a sister club that was out the back door. And I was contacted by the auditor to say, should he qualify? Well, in fact, he shouldn't have accepted the audit, I don't think. I think that's an unacceptable framework, because a framework is a set of policies. So, what have we learned from all this? The auditor must understand the proposed basis of accounting. If it's not an established framework, you should say, hey, okay, what policies are you going to use? And then, same as last year. So read last year's statement of accounting policy. It's not, in my view, satisfactory to say, they don't have a statutory framework, they can prepare special purpose financial statements, they can do anything like that. They cannot do anything they like. So what does the auditor do? It's all in the engagement letter. The engagement letter, the client must acknowledge their responsibilities, which most engagement letters do, because we've copied from a good example. Check yours for the access to all people. And the engagement letter, I think, must identify the framework, whatever it is. And it might be the accounting policies in the attached appendix. If it's not a framework with a name, like NZIFRS RDR or PBE, or whatever the tier 3 and 4 ones are. So we say you will be preparing accounts based on the following, on the accounting policies in the attached appendix. Get it in the engagement letter so there's no doubts, no confusion. And for your records, that's where you look in the standards for if you want to check something. We've talked only about audits of historical financial statements. There are very similar provisions for other types of audits. And there's the one for ISI NZ 3000, which is all audits of that are not historical financial information, SAE 3100 and SAE 3150, and there's also one in the greenhouse gases one, which I didn't bother to put on. So it's very much the same thing. You have to agree on what access you have to records and whether the basis on which they are reporting and you are opining is an appropriate one. Okay. Any more questions? Yes, you can type them into a Q&A and you will get an email back from me within the next 24 hours. And there's, okay, no, I've something in the chat, but right, I think that's two. Oh, yes, I can now see that two participants, a couple of people have raised their hands. But okay, sorry we've overrun, but I hope we have. SPFR, you say for profit. Can you have SPFR not for profit? SPFR is specifically designed for for-profit entities for special purpose reporting. Is it appropriate for all not-for-profits? I think it's it probably is, but I will answer that by an email. Okay, right. Thank you, everybody. We can now get back to work. And the next webinar is on the 19th of December at 3:30 p.m. Nice light-hearted look at using controls in small audits. So you can, in which circumstances can we usefully use controls testing in a small audit? Because a lot of auditors say, "Oh, it's small. I'm going to go straight into doing a substantive-based audit," and indeed, that is quite often a good approach, but not every time. And going through the chats, which I think that I'm not certain I get a record of the chats. I better run through these question options. Yes, options have to, opt-out options have to be done every year. It doesn't carry forward, not the way I read the Act. Could you move the client to Tier 2 instead of Tier 3 to deal with the statement of service performance? And the answer is, at the moment, yes, you can. But that's a very expensive way. I think it would be cheaper and easier to write a statement of service performance. Could you have two engagements, one for the financials and the second one on the full performance report? I think that would be two engagements, and two separate engagement letters I think would be quite a good idea. What framework do body corporates usually report under? They have some, I'll look that one up and get back to you. There is something in their Act, and you will get a copy of the bulletin with nearly all the current accounting rules for all sorts of entities in the next 24 hours. Okay, that's it. Farewell, everyone, and see you in 12 days' time.